I'd like to preface this video by stating again that I think the monetary system of the world is going to be reset. I make no claim to knowing the timing of this event. I only claim that it's a mathematical certainty. Will it happen this year? Probably not. Will it happen this decade? Perhaps. Will it happen within the next couple of decades? More than likely. I doubt that anyone knows the timing with any degree of certainty. The inevitable can take its time, and in the meantime we must live our lives. What should concern us in the more immediate future is the path that we will take on our way to the inevitable. When the reset comes, it will probably be sudden, and the currency of the world will lose their purchasing power quickly as confidence is lost. But on the way there, what should we expect? Should we expect debt to become easier to pay off or more difficult? It's a pretty important question because it may have bearing on your decisions. After all, many right now are under the impression that low interest rates mean that debt is easy to pay off and will continue to be easy to pay off, and so they stay in debt. Is this the right way to look at things? Let's explore this topic. We'll start with a discussion of the yield curve because it will be necessary for understanding the remainder of this video. Here we see a curve drawn between 1-year debt and 10-year debt. I'm picking arbitrary interest rates that have no bearing on the current rate environment. I'm just trying to make some points. Banks will typically pay interest on deposits based upon very short-term rates. In the current example, the short-term rate here is 3%. The deposits consist of the savings of ordinary people. They also consist of deposits of companies who need liquid funds, for example, to make payroll every week. The banks will lend money long-term, typically 10 years or longer. The interest rate on long-term debt is almost always higher than short-term rates, and the difference is what the bank pockets as its profit. In normal times, the spread between short and long-term debt is about 2.5%, but historically the spread has varied. So let's add a couple of other curves that we've seen from time to time. The curve in the middle is a more or less normal curve. The curve at the top is quite a bit steeper. It's called a steep yield curve. This is what happens when the demand for loans is significantly higher than the availability of funds to lend. In this case, the people who want to borrow compete in the marketplace for funds. Long-term rates are driven up, and banks earn higher rates of profit. Contrast this to the curve on the bottom, which is known as a flat yield curve. Flat yield curves typically accompany a recession. In this situation, the demand for loans is low relative to the funds available to lend. In this environment, the banks don't make much money on loans if they make any money at all. As a consequence, the banks will be very hesitant to even make loans. And this is where the Fed has its greatest influence. The Fed can change the Fed funds rate, which dictates short-term interest rates. The Federal Reserve can make it more or less attractive for banks to make loans simply by manipulating the short end of the curve and causing the curve to steepen or flatten. Let's take a look at how the Fed's actions have changed the spread over the past 60 years. Here we see that we've been through many cycles in interest rate spreads over the past 60 years. The Fed has encouraged and discouraged lending many times over and over in cyclic fashion. These actions can create short-term boom and bust cycles. As the spread climbs and reaches 5%, we've generally seen quite a bit of credit extended. When the Fed raises short-term rates, the spread narrows. We've seen a few times when the spread has gone to zero or even negative due to Federal Reserve actions. Typically, shortly afterwards, we've seen recessions take place. Of course, this is very short-term. The Fed funds rate bounces up and it bounces down in short-term cycles. But does the Fed influence long-term trends in interest rates? Let's take a look and see. Over 60 years, we've seen two distinct periods of time with interest rates climbing in the period leading up to 1982, and then interest rates falling continuously up to the present time. Notice how slowly the trend in the 10-year note and the Moody's AAA bond yield have changed with time. They haven't moved nearly as frantically as the Fed funds rate has. Sure, the longer-term rates have fluctuated somewhat short-term, but there are long-term secular trends at play here that are much more important. So from 1950 to about 1980, long-term rates rose, and the Fed funds rate tracked the longer-term trend, generally keeping yield spreads in the neighborhood of 0 to 4 or 5%. We'll explore the forces that resulted in the upward trend of long-term interest rates, but for now, notice that the Fed's fund rate followed the general trend, with little fits and starts that influenced the short term much more than they influenced the long term. From 1980 onward, long-term rates declined. The Fed funds rate followed along. Periodically, the Fed would try to spur on growth by lowering short-term rates, and then have to correct itself to rein in speculative activity. Each time this cycle played out, it played out at generally lower rates. But if it's not the Fed dictating long-term rates, what is? Why did rates rise up to 1982 and then fall to the present? Well, it has to do with economic forces that are much more powerful than the Federal Reserve, even though the Fed would like for you to think differently. As I've stated many times in the past, it's the people in the economy who create the demand for money and credit. When conditions favor expansion, people strive to pull future production into the present by borrowing funds with which to make purchases. And this creates the demand for goods and services that tend to increase prices. It's this activity that provides the funds necessary to consume in the present. For example, buying a house with borrowed money rather than having to save for it. It's also this activity that allows businesses to buy plant and equipment with which to produce the goods that everyone is clamoring to buy. One of the primary determinants to whether or not an economy can expand is the price of oil. We live in a very energy-intensive economy, and obviously the cheaper and more plentiful oil is as a cost of production, the more favorable it will be to economic expansion. But how can we measure the price of oil without using the dollar as a measure? After all, the dollar is a constantly declining yardstick. Well, we can simply use the continuous commodity index. Here I show the cost of oil relative to the CCI. Notice that oil was very, very cheap as a raw material before the mid-1970s. And it's no coincidence that conventional oil production in the US peaked in the early 1970s. Afterward, the cost of oil started to climb. Notice that in the 1980s and 1990s, the relative price of oil was fairly flat, but it was still quite a bit more expensive than it was in the 1950s and 60s. This was obviously less favorable to economic expansion. Notice further that after the year 2000, the price of oil climbed quite a bit relative to other commodities. And this has had a retarding effect on the ability of the economy to expand. Yes, we've seen the price of oil drop considerably in the past year, but we're still orders of magnitude higher than the 1950s and 60s when the economy expanded rapidly. But oil isn't the only factor that leads to economic growth. The number of people available to work and working has a critical impact as well. Let's look at that trend now. Here's a graph of US total employment over the past 60 years. It's shown growth, quite a bit of it. Some of it due to increases in the US population, some of it due to the fact that more and more women decided to enter the workforce in the middle of the last century, which created quite a bit of available labor. It's not very clear what we can make of this chart in its current form, so let's manipulate it slightly. To show rates of growth, I'm going to plot the data on a logarithmic scale. Simply stated, constant growth on a logarithmic scale will show up as a straight line of constant slope. The slope of the line is the rate of growth. To make trends easier to see, I broke the curve up into 3 segments with different colors used for each segment. Notice that the period leading up to the 1980s had the highest rate of employment growth. It was 1.9% per year. Much of this was demographically driven. The baby boom generation entered the workforce, and at the same time many more women decided to work. After 1980, employment growth slowed to about 1.6% per year. This might not seem like much, but it is a considerably lower rate of growth. Fewer people working takes pressure off of the demand for loans. That's not to say that debt levels contract, only that there's less demand for debt, and so one could expect that interest rates would decline. After the year 2000, the growth rate in employment slowed considerably to only 0.5% per year. Compared to the rapidly growing decades of the 50s, 60s, and 70s, our current rate of employment growth is quite slow. Consequently, we should expect that interest rates decline. There is simply less room for the economy to expand and less demand for credit. Now let's explore consumer debt. Remember that I said debt levels can continue to expand while rates decline. Let's look at mortgage debt to show that this is the case, and I'm choosing mortgage debt because it's a consumer debt that's independent of the federal debt. I'm using a log scale again to plot mortgage debt just so that you can get a feel for the rate of change of expansion of the debt. Again, I've broken the chart up into the same 3 time periods as before. You can see that mortgage debt levels have almost monotonically increased, though a monotonic increase does not mean a constant rate. In the period leading up to 1980, mortgage debt expanded at 11.2% per year. From 1980 to 2000, mortgage debt growth slowed quite a bit to 8.4% per year. Finally, in the past decade and a half, we've seen mortgage debt growth slow to 5.2% per year. Clearly, growth in recent years is much slower than it was leading up to 1980. This is a sign that the economy does not have the same factors that are favorable to expansion as they once did. It's also a sign that the borrower is getting tapped out and simply does not have the same appetite for borrowing funds from the future that he or she once did. Now, let's go back and talk about the big picture for rates and what it might portend for our future. Putting it all together, we can see that in the years leading up to 1980, we had available to us very cheap and abundant oil. We also had a rapidly growing workforce here in America. The baby boomers were entering the workforce, as were more and more women. Between cheap energy inputs and lots of people working, the conditions were perfect for rapid economic expansion. Businesses found it very attractive to borrow to purchase plant and equipment, and the consumer was confident and borrowed to buy consumption goods such as cars and houses. It created a virtuous cycle. Of course, at the same time, the demand for all of these borrowed funds put upward pressure on long-term interest rates. On the flip side, we've seen the conditions that were favorable for growth reverse since 1980, and the reversal has accelerated since the year 2000. Consumer debt is still growing, but at a much slower pace, as is evident in the mortgage curve that I showed you. This has had the impact of causing long-term rates to gradually decline to where they are now. We can see the Fed action from a different light now. The Fed is like the proverbial tempest in the teapot, a bunch of sound and fury signifying nothing. Sure, there have been short-term booms and busts as a result of their actions and its impact on yield spreads. But as far as secular trends in interest rates are concerned, the Fed is simply following the market-driven trend. It is true that the yield spread is currently fairly high. One might think that the Fed could raise interest rates now, but notice that long-term rates are on the decline. If the Fed raised rates now, it would not be long before they would have to reverse course, and the last thing that they want is more forced action to call into question their omnipotence. But assuming that it's the market that's dictating long-term rates and their trend, where are things likely to go from here? Well, one simply has to ask the question, are the conditions for a growing economy coming back? I have my opinion, and I'm sure you have yours. But if the conditions don't come back, then long-term rates will continue to decline. This will be a symptom of the will to borrow money declining further. Eventually, the growth rate in debt levels at ever-declining interest rates will turn into an actual decline in debt levels at interest rates that put a serious squeeze on bank profits, even with Fed funds pegged at zero. This, ladies and gentlemen, is what's going to put the stress on the monetary system that will result in its reset. It's not going to be a flood of cheap and easy money. No. It's going to be a continued trend of debt becoming harder and harder to pay that's going to put the nails in the coffin. Think hard on this and decide for yourself what you believe.